Last Friday's jobs report showed hiring slowed in October. Unemployment remained at 4.1%, but U.S. payrolls grew by only 12,000. That was in part because of Hurricanes Helene and Milton, also the strike at Boeing. For a look at how these numbers may impact the Fed as the central bank heads into their two-day meeting later this week, we want to bring in former Fed Vice Chairman Roger Ferguson. He's former TIAA president and CEO. He's now vice chairman of the Business Council and a CNBC contributor. And Roger, thank you for being here this morning. The Wall Street Journal had an article over the weekend that suggested that the Fed was going to look through those weaker than anticipated jobs numbers that we got on Friday. Do you think that's the case?
I think it's the case. I think they should look through them. As you point out, it was driven by hurricanes and a strike. And the underlying economy is certainly stronger than that kind of labor market would suggest. So I think they'll look through them, and I think they'll do what the market expects, which is a 25 basis point cut.
If they're looking through it and the market's weaker than anticipated, or the market's maybe not as weak as those numbers anticipated, why not hold off? Why not wait and see?
Well, a couple of reasons. One is, this is a week where I think the Fed just wants to be in and out and doesn't want to surprise anyone. So there's let's do what's expected. Secondly, at the last meeting, they suggested that they still had some way to go to get towards neutral, and I think they do. And so I think the best judgment this time and when they will follow is to do what the market expects. It may be when they get to the next meeting, depending on how the data play in over the next period of time, that meeting may be a little bit more interesting one, where possibly other ideas might be on the table. But this one, it seems like both the data and prudence suggest doing as the market expects.
Is there any way to not look political if you cut by 50 basis points right before the election, 50 basis points during an election, essentially, and then hold off afterwards and say we're going to wait and see at that point when we hopefully we'll know who the next candidate or the next president is going to be at that point? I guess the answer is you're always looking to not pay any attention to the politics and it doesn't enter the room or the question. But from the outside perspective, it seems like it might open them to criticism.
Look, there's always a risk of that, but I think the reality is, the data on balance have been consistent with the fact that inflation is coming down. There's no one who can deny that. I think almost everyone would say that at the numbers where they currently are, they're in somewhat restrictive territory. So now was the time to start moving. The 50 basis point move as their first was, could have gone either way. But nevertheless, they made a decision to move a little bit more quickly. And this time and maybe the next time, depending on how the data play out, it's just carrying out a plan that had already been put in place. And I'd say the vast majority of people take it at face value as being consistent with inflation coming down and the desire to get back to that elusive thing known as neutral. So I would say for most people, politics are not going to be what they think about when they think about the Fed. I think it's rather that the data encourage, mandated, allow this kind of movement towards less restrictive territory.
Roger, just from everything you see, everything you hear, people you talk to, what's your best estimate of where we are in the economy right now?
I think the economy is in good shape overall, but there are certainly some pockets where it's not as good as one would hope. Obviously, we still have some fundamental supply and demand imbalances in the housing sector. We're short several million houses, and that's creating difficulty for people who want to get into housing. There are parts of manufacturing that I think are still relatively weak, and I've heard that from a few CEOs in that space as well. The flip side, obviously, is technology is driving things forward in a positive way. And importantly, though there's some stresses at the lower end of the consumer spectrum, most consumers are doing reasonably well, partially because wages are picking up and have kept up with inflation or outstripping it. And then for those who are fortunate enough to be in equity markets, obviously this thing called the wealth effect has been important. So on balance, a good, solid economy with some pockets of weakness and some unevenness in certain sectors.
And if you were in the chair, if you were in this FOMC meeting and had a vote, you would vote to cut 25 basis points this time, and you would vote to hold off next time, all things being equal, if you don't see any big new developments in data between now and then?
I would certainly vote for 25 this time, and I would still think 25 should be probably the better move next time unless the data really surprise us. And the reason is that, however one cuts it, they still are certainly somewhat in restrictive territory. And there's no reason to be in restrictive territory when right now I think they want to be neutral. So I'm fully on board with a total of 100 basis points of cuts now that, adding 50 over the next two meetings. And then wait and see. Now, as you say, subject to no major surprises. But I think they are right to be in a somewhat easing mode, though where they end up, I think, will be the next big debate. What is neutral? Where do they stop? How many cuts are left will be the next big debate. And I think that will be a serious and important debate for them to have next year.